Hey, all, it's going to be a post about manufacturing PMI results for all of the countries that are involved, or at least all of the countries that are involved in the iFund that actually do produce manufacturing PMI data for us. That accounts for about 97.9, just about 98% of the entire, all of the countries in that particular fund. We want to get an idea of what's going on economically with those countries. So, and this gives us a good composite view here. I'm going to take you to the view now of the data table I work with here. Okay, these are all the countries that are both in the iFund and that also have manufacturing PMI data to put out. Okay, manufacturing PMI. PMI is the Purchasing Managers Index. What it does is it's a survey that gets put out in each country, asking for inputs from businesses in the different industries within the manufacturing sector. Um, hey, what's their sentiment? Are they growing, or are they contracting, or whatever? It goes into more detail on the U.S. side. Well, all we really get access to very easily on the international side is just the overall score. And this is what you're looking at right here. You can see the trend. The composite is what really concerns us the most. As you see here, 98% of the countries that are representatives of the iFund, or 98% of the strength of the iFund is represented by all these countries you see in this list. There are a few others that are also in there that do not have manufacturing PMI data. China is not one of the countries that is in this fund, though. So I don't want you thinking that things going on between U.S. and China trade issues necessarily has any direct impact on what goes on here. It could indirectly through other trade issues like with China and all the countries that are actually in the iFund, what their trade relations are like, and what kind of foreign demand each puts on each other. But that's about it. Otherwise, what we really have to work with is what is easy to get access to, which is mostly what you see here. I don't have good, easy access to the earnings data for all the companies in the iFund, and on top of that, the iFund is not just affected by corporate earnings and from companies that are based in these countries, but also by currency exchange rates from all these countries as well. So there's a lot more variability in there. But we're more concerned about what's going on economically on the global front, and that's what this information is designed to tell us about. All right, so if you come over here, looking at the composite again, back in November, there was 52.8% of all the respondents were saying they were growing, and then it's basically been steadily downhill. Now it's just barely flatlined. So 50.0 means exactly the same number of responses are reporting growth as there are contraction, or vice versa. If you're more of a bear, as many countries or companies in those countries are reporting contraction as there are growth. So we're barely above water at the moment right now as far as March is concerned. Now Israel is the only one that I don't have data yet for March. As you see, they actually have had a couple of weak months over the last couple of months, but we're a little bit stronger. But even then, even if they have a good report on their next one, they're only about 0.5% of the strength of the iFund. So that's not really going to change us by any real amount. Maybe 0.1% or something. That's about it. Who concerns us the most? These are the countries that have the strongest weight on the index. The strongest is Japan at 24%, and as you see here, they had mild to moderate growth. I would say mild, not mild, but not moderate. I would say actually, just some kind of that somewhere in between range. And then they went to just barely above water in January, and then they fell below 50, which means that more companies in Japan are starting to report contraction than they are growth. Now they did recover a little bit with the most recent report, but also keep in mind a lot of these countries also do revise their PMI data. So next month when I go through this data again, some of this information could change, whether they might go upward or might go downward. We don't know, but next month we'll actually see revisions appear in here, and we can actually see the effects of it. All right, so aside from Japan, the other countries that have stronger influences are United Kingdom. They're actually looking pretty good. They're actually looking stronger now than they were in November. In fact, this is the strongest reading in March that has been seen in basically in the 5 good months of data that I have to work with at the moment. So that's a good sign. But Japan on the weaker side, and their stronger influence, that is one area of concern. Also, France, just over 10.5% influence on the index. They were weak, mild growth, I would say, in November, to mild contraction in December, to kind of mild, a little bit better mild growth in January and February, and now they're back in contraction territory. So they're kind of all over the place. And if you just look at all these, we're just, this composite actually influences all of these. So all of these have different weight factors based on what percent of the index is represented by that country. And I get a composite score down here automatically from it. As you see, though, it is a downward trend. So this is a concern for global stocks. And when it's a concern for global stocks, it's also a concern for global demand. Doesn't necessarily mean it's a concern for the U.S. economy as a whole, but it does mean that I would expect there to be less demand from foreign customers on the U.S. products and services. Who's that expected to affect the most? That's going to affect the C fund companies more, the larger cap companies that are more heavily influenced by the international trade. The S fund companies are smaller in nature. They don't tend to have as strong an international customer base, so they're not likely to see as much of a impact from this. So I've talked recently in the past before about how I don't like the I fund, and this is even more reason to not like the I fund at the moment. Now, at some point in time when this data shows me something different, and I see other information in the U.S. ISM data that I always talk about at the beginning of each month, that can change. We just have to wait to see when that actually does happen, though. Until that actually does happen, I would stay out of the I fund. All right, so again, I would focus mostly on the S fund personally, based on this, as well as the ISM data that came out earlier this month that I also did report on. And if you don't want to have all your money in the S fund, you can still have a balance between C and S, whatever you want. Deb is still a little more strongly in favor of the C fund. I'm still more strongly in favor of the S fund. Just go with whatever you believe is better. Also, if you don't want to have 100% in stock funds, just limit yourself to the G fund, and a portion of your money to the G fund, and the rest of it in C and or S funds. But as I've already been saying here, preferably the S fund. Now, that's all I have for now. Hope that's good information for some of you guys. Now, I will also say, though, when it comes to stock prices, short term, you can actually see a much different picture going on with the technical analysis side of it. The chart technicals. I don't tend to cover that at all, or very limited myself. However, my friend Jerry Horan does talk about it in his group, Grow My Thrift Savings Plan. If you want to get that kind of insight on what's going on, at least on the chart technical aspect, he has a lot of good information in there. I focus more on the fundamentals, which is the economic and earnings data. So it's really just two completely different perspectives on this, and it's all good information for you to absorb. But I hope this is all. Hope you got a lot of good inputs from this, and take my advice, stay out of the I fund. Thanks.